Good morning, everyone, and welcome to our Thought Leadership series hosted by the School of Financial Services at Milpark. My name is Somila Ntinge, and I'm from the marketing team. Joining me today is David Fente, who is head of school, and he will be presenting our speaker a bit later on. Just a bit of housekeeping from my side before we move on to David and Mike. You will notice on the right-hand side of your screen, there is an interactive chat box. I see everyone has been chatting. Nice to meet you, and thank you for letting us where you're joining from. And also at the bottom of our screen, we have a poll running. So if you want to get more information around our qualifications, please click on yes, and this will give us rights to actually call you and tell you more about our qualification. And if you want to look at Milpark and all our other courses, you can click on our visit our website tab, which is under our call to action button. So before wasting time, I'm going to hand over to David to introduce our speaker. There will be a Q&A session later on. So in the meantime, you can pop all your questions on the ask a question box at the bottom of the screen, and we will take care of those questions just before the end of our talk. So over to you, David. Enjoy.
Thank you, Samila. So firstly, thanks all for everyone who's joined today. I see we're up to around 500 people, so it's very exciting to see that everyone is keen to join our School of Financial Services Thought Leadership Series webinar today. As Samila said, we're very excited to have Mike Keenan as our guest today. He is head of fixed income and currency strategy at ABSA CIB, and myself and Mike go way back. I still remember him coming through to my old offices back in Constantia back in the day. That must be like 15 years ago, where he'd come about every quarter or so to chat through with the various fund managers his thoughts on where the market is. And that's why I thought today would be wonderful to have him join us for a session today to talk through what's currently happening in the interest rate market within South Africa, what the road ahead looks like, how one would look at how the South African Reserve Bank are looking at interest rates and their trajectory, and conversations all around that. So as Samila said, what we're going to do is we'll hand over to Mike. He'll talk for 20 to 30 minutes. And so please, while he's talking, please feel free to put questions through to him as he's going along, and we'll revert back to those questions at the end, and we can then have a bit of a dialogue at the end with any questions. So with that, I just want to hand over to you, Mike. All the best.
Thanks very much, David, and good morning to everybody. Thank you so much for dialing in. I'm going to load up my presentation, and then we can get going. Just want to confirm, David, you guys can see from that side everything?
Yeah, I can see perfectly. Thanks, Mike. Looks great.
Fantastic. Okay. Well, thank you very much, David, for the introduction, and thanks very much for the opportunity to talk about one of my favorite topics, policy rates. At the bank, I'm in the research department. I look at currencies as well as interest rates, from the policy rate all the way to the back end of the yield curve, so all the bonds forms under my jurisdiction. And as David mentioned, we're going to be looking at policy rates today. So I thought perhaps a way of looking at this at the situation is, first of all, defining what inflation targeting is all about, because that inflation targeting framework ultimately decides, what the policy rate is of the day. I think we also need to just have a look at inflationary trends historically before we move into the actual current situation. What does inflation look like in South Africa? And ultimately, what is the outlook for policy rates going forward? So I've got a number of slides to get through. Let's go quickly and then we can get into some questions afterwards. So what is inflation targeting? I've jotted down a couple of points here in terms of what the Reserve Bank's mandate is all about. What are they preoccupied with, for most hours of the day? And their primary objective is to actually protect the value of the currency in the interests of balanced and sustainable economic growth. Now, that sounds like quite a mouthful. So maybe let's just break it down a little bit further. How do you protect the value of the currency and achieve sustainably high levels of growth? Well, according to economic theory, purchasing power parity theory in particular, a currency will normally weaken when the general price level of a particular country is rising faster than its trading partners. So in other words, to prevent the rand from just weakening continuously due to high inflation, you've actually got to try and stop inflation from getting out of hand. And that's why since 2000, the Reserve Bank has formally adopted inflation targeting, and the SARB likes to try and keep inflation within a 3 to 6% band on a continuous basis. There are going to be times when there are breaches to the top and to the downside, but as long as they are temporary in nature, the Reserve Bank is doing its job. Who decides the actual inflation target? Well, it's a combination of the National Treasury as well as the governor of the Reserve Bank, who ultimately comes up with that target. And once that target has been decided, I think the next very important point is that the Reserve Bank then has the ability to carry out its mandate independently. It's very important. Yes.
Sorry to interrupt you, man. I just wanted to make sure there's been a couple of queries on the side around the slides not changing. I'm not sure if you're still sitting on slide 1. Just wanted to check if you were still on slide 1. If not, then
I've gone on to this. Can you guys see the SARB's mandate or not?
No, we can't. So maybe then just do it on our screen. We're still seeing your first slide, Milpark School of Financial Services.
Okay.
Let's see if we're going to get this sorted out, guys.
Let me just see how I do this. Okay, I'm just going to try and reload it. Let's have a look.
Great.
Sorry about this, everyone. But it's better that we know about it early on, otherwise.
Exactly.
Let's have a look there. Share.
Okay, so sharing again. So now let's go forward and back a slide to see if that works.
Does it change?
No, not changing. Possibly then the share screen, like we tried before.
Let me just try and go back.
Apologies for this, guys. This is always the thing when it comes to. It was working fine when we tested out earlier. These are always the gremlins that come in. So
let me try this one. I'm trying another one, and then does that change?
Yes, there we go. That's it. Perfect.
Okay, fantastic. Okay, so don't worry, everybody. We were still on the very boring bits, so we didn't miss too much, David. I hope that no one's really missed any of the exciting pictures, which are still en route. So I was just going through sort of the SARB's mandate, drilling through all these bullet points, and like we were saying, I think when we left off was that the finance minister as well as the Reserve Bank governor decides on the inflation target, which is currently 3 to 6, and then after that, the central bank has the ability to carry out or should carry out its mandate independently. So you can't then have sort of politicians or anybody else for that matter then influencing Reserve Bank policy. Once you give them the mandate, they have got to sort of run with the ball thereafter. And, the division within the central bank that actually decides on the repo rate and ultimately is responsible for achieving the target is the Monetary Policy Committee, which we're going to refer to as the MPC from here on out. One, slight tweak in sort of the target measure came about in 2017 when the Reserve Bank's MPC came out and said they actually don't want inflation just to come in below 6%. They would actually like inflation to be closer to the midpoint of the band. So 4.5 is kind of the implicit target. So they've made it a little bit more challenging for themselves, but ultimately they want to make sure that they don't, only just get inflation below 6% and then you get some kind of an exogenous shock like a high oil price or currency weakness, and there's not much buffer between prevailing inflation rate and the target. So they've been more recently sort of targeting more the 4.5%. Now in terms of sort of the sources of inflation, some of you guys might be well aware of this, but there's a few driving forces behind inflation. We won't spend too much time on this. The one is the demand pull. So that's basically when, people are going out, businesses are spending a lot, consumers are buying a lot. And as that search for goods intensifies, it drives up prices because there's basically not enough goods to go around for all the demand, and that pushes things up. The other sort of price pressure can come from the cost or the supply side. That's when you have something like an oil price shooting up. It might have nothing to do with the level of demand in a country, but maybe there's a war or there's some kind of outage on the oil pipelines, and suddenly there's not enough oil coming out the ground. People still need to drive, their cars, etc., run their business operations, and that then pushes up their input costs. And then the final one is a very nuanced one, but a very important one, and that is the inflation expectations. So when you and I think that the cost of living is pretty high, prices are rising, we have a perception that inflation is sort of spiraling out of control, and then we go to our bosses and say, well, I can't make ends meet. You need to increase my salary, please. And because you're a good worker, the boss likes what you do, he increases your salary. And of course, then that feeds through into the cost of the company and ultimately through into the final product of what that company is producing. So inflation expectations also comes through as a potential source of inflation through sort of the wage channel. So these are the three sort of core areas where you can get inflation. I want to also just talk about the MPC committee. So we talk about the guys that ultimately make the call. There's 5 members in the committee at the moment. I've got the deputy governors as well as the governor, and then the head of research, which decides on policy rates. I'm sure these names are familiar to most people. We hear their names in the press all the time. And
sorry, Mark, to interrupt you again, but it seems like your slides then have paused again. We're still on the topics of discussion slides.
Does it change?
Yes, now we're with Letsecho. There we go.
Okay, that's so strange. But anyway, just keep, if it happens again, just let me know. I think, okay, I've got an idea what might be happening. Okay, so here are the mug shots of all the MPC members. And these are the folks that decide on policy rates on a regular basis. On this next slide here, I just highlight when they actually meet and decide on what the policy rate should be. So the MPC dates are here on the left. Basically, they meet every alternate month to decide. We've just had the May meeting. So the next one will be in July, and then we've got 2 more after that. There's 2 other sort of events that give us a sense of what the MPC is thinking about policy rates. The monetary policy review, just from a space constraint, I abbreviated them. But the monetary policy review is also a very deep dive bit of analysis that the Reserve Bank does in terms of how they are doing in terms of the inflation targeting mandates. There's a lot of detailed analysis that goes into these reports. They get published, and there's normally a presentation twice a year. And then you've got the monetary policy implementation framework. So this is another sort of branch of the SARB that looks at whether or not these policy rates are actually having the desired effect. The Reserve Bank predominantly uses the policy rate to sort of govern the level of inflation, but there are other measures, reserve requirements, liquidity management. We're not going to go into all of those details today, but those are the kind of meetings that also give the market an indication of whether or not the central bank feels like it's winning its fight against inflation, keeping sort of inflation under control. So those are some key events just to sort of bear in mind. But basically how monetary policy works, or the so-called transmission mechanism, is multifaceted. So, like we said a bit earlier, they are trying to protect the value of the exchange rate by keeping inflation low. So one of the channels will be through the exchange rate. If the exchange rate is steady, you don't start importing a lot of inflation. You can see your import spending. You also don't want your exchange rate to become too strong, because then you hurt growth. That was also part of the Reserve Bank's mandate. If your exports become uncompetitive due to a very strong exchange rate, that's not a good thing either. So they like to keep the trade account in balance. But ultimately, it's the import prices that normally drive your imported inflation. So that's the one channel, through the exchange rate. Then the second channel is really through your demand and sort of your cost push. Your demand will influence, your asset prices, which feed through into things like, wealth effects. Your cost of capital or your interest rates also influence how much the banks charge us when we want to take out a loan to buy a car or a house. So, that ultimately controls a lot of your demand side pressures, but there can also be cost push pressures that come through into businesses. And then finally, you've got those inflation expectations, which I was talking about. And there you can see wages are explicitly mentioned as a channel through which inflation can come through. But all 3 of these, whether it's the exchange rate, sort of the demand, or wages, they ultimately all filter through into the level of inflation, and that's the target. That's what the Reserve Bank is trying to keep a handle on. And that serves as a very key anchor for a lot of other policies. If you are targeting inflation and you've got a policy rate instrument that's looking to govern that, the market can then say, okay, well, we know what the authorities are trying to do. So if we can, if we want to find out where the markets are going to be trading going forward, specifically interest rates, then we've got to start at the base rate. We've got to start at the repo, the policy rate. And to do that, we need to have a good understanding of inflationary trends, because inflation will drive interest rates, and interest rates will drive market performances, market bond yields, etc., etc. So this is just a bit of a schematic on the transmission mechanism, and hopefully that was a very quick but hopefully helpful guide as to where inflation targeting comes from and what it's all about. Let's move on to the second section, which I want to talk about today, and that is just how have we actually done in terms of achieving sort of price stability? Has the Reserve Bank been successful in its inflation targeting mandate? And here's a chart that shows us the actual inflation rate, the red line, that's been, how inflation has been trending over the years. And then alongside that, you've got the policy rate. And for good measure, I've just thrown in the various MPC, governors, central bank governors that we've had sort of over the years. So you can see under the Mboweni administration, which is probably the time that Dave and I used to chat, things were quite volatile. We saw inflation rocketing to very, very high levels. The Reserve Bank had to hike policy rates, and then inflation did come down. And then when it started rising again, they had to hike rates, and then once things were coming down, they were able to cut. Jill Marcus didn't change policy rates all that much during her tenure. There were a few cuts and later a few hikes, but it was not nearly as volatile as under the Mboweni administration. And then with the current governor, Lesetja Kganyago, we saw a bit of a shift in inflationary pressures. They trended lower for a long period of time. And that's, I think, when the Reserve Bank felt, well, let's strike while the iron's hot. Let's actually push the inflation target lower. By doing that, you also help to shape inflation expectations, which actually becomes a self-fulfilling story. If you move the target lower, then people buy into that, and they set their wages not at 6% anymore, but now at sort of 4.5%. So it is sort of self-serving in a way by lowering the target, but it's not an easy task. And as you can see, since sort of the pandemic, we started to see prices rising, and now we are back not only above the 4.5, but we actually are above the old 6% sort of target. So that's how we've performed over the years. I think another way of thinking about whether or not monetary policy is tight or loose is not just to look at the base rate, so not just to look at the repo rate itself, but to look at the spread of the repo rate over inflation. So that's what we had in the last chart. I showed you the policy rate and inflation. And if you subtract the two, you actually get what we call real policy rates. And there's two ways of looking at real policy rates. One, you can have a look at the current repo rate, less the current inflation rate, which was in the previous chart. Or you can have a more forward-looking approach and say, what is the current repo rate minus the expected inflation rate in a year or 2 years' time? And the reason why people like to look also at a forward-looking rate is because they say that, what the central bank does today in terms of policy rates will take time to influence the economy. It will take, the lag, they say, is somewhere between 12 and 18 months between when you actually move on policy rates and when it has the full effect on the economy. So a forward-looking inflation or real rate is probably quite a good idea in terms of determining whether monetary policy is tight or loose. What we can see here is that monetary policy was pretty tight back then. Real policy rates were high. It wasn't just a nominal rate. Then things settled down, inflation came under control, and real policy rates were actually not that high. We're starting to move up now, back to those levels, because during the pandemic and during sort of over here, which was when we had the global financial crisis, the central banks were trying to help revive the economy. So they were prepared to run very loose monetary policy at the time. But now that inflation has, raised its ugly head, we are seeing them tightening up, and real policy rates are moving back up to the levels that we saw sort of pre-pandemic. Another way of just examining whether or not, the SARB is achieving its target is to look at what the actual inflation rates have been over sort of various periods. So I think this chart would encourage the governor, because over the past 20 years, we averaged inflation of 5.3. In the previous 5 years, despite all the the volatility, etc., he's actually, now sitting with an average inflation rate of below 5%. So it looks as though the market, consumers, businesses, we all sort of coming around to the idea that we are in a country that targets inflation, and we've got to set our prices accordingly. Not everybody gets the message. I'll be quick to highlight that point. We are sitting with certain inflationary pressures that are still stubbornly high, and we'll talk about that. But I'm sure you guys probably know what I'm referring to. Things like electricity prices are something that seem to defy inflation targeting mandates. The final two measures that we can look at to determine whether or not the central bank is achieving its goals would be surveyed inflation. So what we've been looking at just now is actual inflation that's published by Stats SA. But the Bureau for Economic Research runs a survey where they ask a variety of individuals, it's trade unions, businesses, and analysts, what they think about inflation in the current year, 1 year ahead, and 2 years ahead. And what we can see here is that there again, inflation expectations have moved lower, generally in the target band. They've popped more recently to above 6%, and they're definitely above the 4.5%. But I think generally, as we can see here, most people are getting it, that inflation targeting is real, and the Reserve Bank will hike policy rates as is needed to ensure that they get to their target. And then the final one is the market. So in the market, in the bond market, we have basically two types of bonds. We've got inflation-linked bonds and we've got normal bonds. And the gap between those two yields gives us what we call a break-even yield. And the difference between an inflation-linked bond and a normal government bond basically is a good proxy for what the market thinks is going to happen to inflation. Because if inflation is going to be high, you buy a lot of linker bonds. If you think inflation is going to be low, you buy your traditional bonds. And we only have data for the past 10 years in this instance. But it's very similar to the final 10 years of this chart, where we see the market also buying into the inflation targeting sort of ideas, but more recently it's moved higher. The longer dated bond yields are generally above the sort of the target range, but there's other factors that can contribute to that, not just pure inflation expectations. There's also other things that can come into it. But if one looks at sort of the 5-year bond yield, break-even yield, which I think is probably the one to look at, it's actually tracked inflation pretty closely. So has surveyed inflation. And that's why, a lot of analysts and the Reserve Bank itself will say that, price setting or inflation expectations is quite adaptive. As inflation's coming down, so people moderate the inflation expectations. and vice versa. I mean, I think that's just sort of human instinct. We go with what we see at any given time. So it is adaptive, and that then influences again wages and things like that. If the cost of living is high today, you're going to go and ask your boss for the wage increase today. You're not going to say, well, I think if the Reserve Bank is going to respond to this high inflation by hiking interest rates, and inflation will come down, in the next 12 to 18 months, and then my wage should be fine. You're not going to do that. You're going to say, I'm not making ends meet. I need a higher wage here and now. So that's also a bit of a subtle nuance of inflation expectations. So we've had a look at sort of what inflation targeting stands for. We've had a look at some of the previous trends. But now let's get into the nuts and bolts of what the Reserve Bank and the market is thinking about inflation, at the moment. Because what they're thinking about at the moment is going to determine, how they act on the policy rate front. So what I've got here is my Spider-Man chart, which, I like to look at on an ongoing basis just to get a sense of, what are the high frequency data that the Reserve Bank tends to look at on an ongoing basis. How are they evolving? Because you will notice if you listen to the MPC statements that they go through normally a certain set of economic data, which is basically illustrated in this chart, at each and every meeting. So this is the stuff that they look at. So it makes sense for us to look at it as well, because then we'll be able to forecast this repo rate probably a little bit more accurately. So we've got CPI, we've got core, producer inflation, money supply, private credit, private sector credit extension. We've got the car sales, the retail sales. So this is telling you what the level of demand is. This is sort of your money aggregates, and this is giving your actual raw inflation. And then the final two, as we've just been speaking about, things like break-even yields and the BER inflation survey. So what the Spider-Man chart is telling us is that if you look at how things have evolved since November, which is the pink line here, for example, producer inflation was out here, and it's moderated all the way down to there. So that's a good thing, right? So that means that producer inflation is coming down. And producer inflation normally leads consumer inflation. Consumer inflation is proving to be a little bit more sticky. You can see there hasn't been as big a change, but this should be encouraging to the Reserve Bank. If you look at money supply and credit extension, there's also been some improvement there from the November levels, but the SARB doesn't really place extensive attention on money aggregates. It used to, actually, before we adopted inflation targeting, but it's not front of mind, but it is worth watching. And then if you look at the demand side of the story, we've seen things like car sales, which is a good leading indicator for economic growth. That has also come in quite a bit. Break-even yields are coming in slowly. And the survey measures are proving to be a little bit sticky. So if we look at the policy rate has been moving higher, and it's essentially starting to have the desired effect, especially on producer inflation. The level of economic activity is slowing, and we are seeing your inflation expectations and things not getting out of control. They are high, but they haven't ballooned. So it's telling us that the market feels that the Reserve Bank's medicine that they're giving to the market will eventually sort of cure the patient. We will start seeing lower levels of inflation with time. So that's a nice little snapshot of the macro data. But what also the Reserve Bank does, which is very, very helpful. And it really, is nice to see a central bank being so transparent, is it gives us, an idea of what they are forecasting for a whole lot of, variables. And they start with looking at the global environment, and then they start moving into the domestic fundamentals. And that ultimately also shapes their policy rate decisions. So let's go through these. There's a lot of information here, and I'm going to move quickly, but hopefully it should be pretty self-explanatory. What I've got here is what the Reserve Bank was forecasting for our trading partners, their economic growth from the November meeting, and how it's evolved through now to the May meeting. And what we can see here is that this year global growth is likely to come off quite a bit from what the levels we saw in 2022. We are seeing the Reserve Bank upwardly revise some of its expectations for growth, but it's still soft compared to previous years, and will only start to regain sort of a bit of traction in 24 and 25 in terms of global demand. Food prices, they are falling internationally, but when it comes to food prices, it's not always a given that lower food prices translate into lower food prices domestically, because our farmers in South Africa are able to export their produce pretty freely, which means that even if global prices are falling and the rand is weakening, the rand can offset that effect of softer global prices. And we'll talk about the rand shortly. So it's a good thing, but that we see in this expected decline, but there are some nuances to this story. Then when it comes to oil prices are expected to fall in this year from previous levels, and they are revising their numbers lower. But again, oil, like food prices, we have to think about it in rand terms, because we have to import the stuff. So it might be dropping in dollar terms, but in rand terms it could be falling. Global commodity prices also softer this year. World prices, which is basically global inflation, also falling. But despite sort of subdued growth, softer prices, the central banks globally, these world interest rates are expected to rise or on a rising trend this year. They will stop rising next year. They will sort of level off, and maybe by 2025 they'll be lower. But it's telling us a story that, even though, prices are coming down, they're still at elevated levels. Countries like the US target inflation of 2%. The same is true for Europe. The same is true for the UK. So this chart might look all very good and well. It's come from 7% down to 4%, but 4% isn't really good enough for them. And that means only by 2024 will they be back in line with their target. And that's why only then maybe can we start seeing some relief in terms of world, interest rates or global interest rates. So that's a bit of their view on the global environment. Then bringing it back to South Africa, the current account. So the current account is probably going to deteriorate according to the SARB. And when you've got a deteriorating current account, normally your exchange rate is weakening, because either you are importing a lot more than you did before, or you're not exporting as much. And we can see a lot of consistency between the current account forecasts and what they're saying about the nominal effective exchange rate, as well as the real effective exchange rate. So this is not just the rand against the dollar. This is the rand against all of our major trading partners, and they weight that level of trading so that you get the actual true reflection of the strength or the weakness of the currency. And what it's telling us is that the SARB expects current account balances to deteriorate, and as a consequence, the rand will remain under pressure. So, again, that is a risk, because even though we've seen maybe softer commodity prices, softer oil, softer grain prices, if the rand is going to weaken by sort of 10%, it can actually offset the gains or the windfalls we're getting from lower low oil prices. And I think we see that in our petrol price increases. They've been generally going up. The other thing is electricity. So electricity is the bugbear of the SARB, because we are targeting inflation of 3 to 6, or they want 4.5. But electricity prices are double digit in South Africa this year. I mean, last year they were at 10. They're probably going to go up even more in the current year, and even further in 2024, as Eskom tries to recoup some money from us to pay for some of those power stations, etc. So this is a challenge, because the Reserve Bank can, stand on its head and appeal to Eskom to sort of limit electricity increases, but Eskom turns around and says, "But we need to be solvent. We need money. So this is what we have to increase electricity by." But this goes into the inflation basket, and it makes it quite challenging for the SARB. The other thing that's challenging for the SARB is our growth, because South Africa's growth is not particularly strong, especially when you compare it to a lot of our other emerging market peers. And the load shedding that we experience in South Africa is aggravating that situation quite immensely. And that's a real killer about load shedding. Besides its inconveniences, it really hurts productivity, and it pushes up prices. So it's a bit of a stagflation kind of impulse into the economy. So it's not great. And if you look at our growth, it's already on the back foot. We are expecting growth, or the SARB is expecting growth to basically be marginally above zero. We're hardly really growing. They expect a bit of a rebound in 24 and 25, but it's very, very limited growth. And it's not like the Reserve Bank feels that we can suddenly grow a lot faster, because the output gap is actually narrowing, which means that our potential growth rates, are actually quite subdued. Look at this potential growth rate. It's very, very low for the current year because of things like load shedding. So even if we wanted to grow more, we can't grow more at a time when you've got this sort of load shedding. So it makes the SARB's job a little bit more difficult, because inflation might be high, as we're going to talk about now, but if you hike rates, you can hurt growth and push us even lower. So that makes it tough for the Reserve Bank. But let's have a look at inflation and the actual forecasts. Inflation is, been pretty high in the last year or so, and well outside the target band. The Reserve Bank does feel that it's going to come down this year, but it's not going to really be below 6%, on average, and it's definitely not going to be at 4.5%. In fact, they only really think it's going to get to 4.5% by 2025. Those are the annual numbers. You can see it a little bit more on a quarterly basis, if you like, on the chart on the right. They are expecting inflation to moderate going forward. But what is interesting is that if you look at the latest forecasts, it is slightly higher than the previous forecast. So the May forecasts are not as rosy as what we had in March. And I think what's driving it is their core inflation readings. If you look at their core inflation, so here you can see the forecasts. There's been quite a marked increase in their expectations. You can see it in the annual data. You can see it in the quarterly data as well. And this is something that's coming through globally. We've seen that central banks hiked rates very aggressively, once the pandemic had sort of settled down, because inflation was outside the band. And, the hope was that those high interest rates were going to bring down a lot of the kind of the cost push pressures that were coming through from the logistical bottlenecks that were associated with the pandemic. So during the pandemic, we couldn't ship things around as easily, and that added huge upward pressure on input costs. But now what's happening? The ships are back on the 7 seas and things are flowing again. But we are moving into an environment where the labor situation, especially in the developed world, is becoming quite scarce. Remember, China's one-child policy that they adopted many years ago is now starting to translate into negative growth rates in China. We're starting to see a lot of we've seen the baby boomers now reaching retirement. So the global labor force is actually shrinking, especially in the developed markets. And that means that the cost of labor is rising. And when the cost of labor rises, what you tend to see is services inflation going higher. And the services inflation is what's driving core inflation. And this is what's worrying central banks globally. And the SARB has adjusted its forecasts higher, but I can assure you this is something that's keeping many a central bank up at night. Yesterday, we had more evidence that the US labor market is still very, very tight. So, some of the indicators are showing that inflation is slowing, but you've got a very strong or very tight labor force, and that makes it difficult for the central banks. I'm running out of time. I can see. I'm going to be quick.
Yeah.
The neutral rate for the SARB, there it is. It's at 2.5%. We are, above that actually now, but that's what they think is the neutral rate for South Africa, where monetary policy is not too tight or too loose. Finally, we have the vote count for the last MPC. So there's a typo here. This should be the vote count for the last MPC. And what's interesting is that all 5 members voted in favor of a 50 basis point hike. In the previous couple of meetings, it was a split affair. We only had 3 of the 5 members voting, and the one before that, actually 3 voted for only 25. But it looks like these central bankers are now a lot more hawkish. How do our policy rates compare to everybody else's? Remember, we are not an island. If we don't have sufficiently high interest rates, we're not going to attract enough capital into South Africa. That causes the rand to weaken, and that aggravates your inflation. Now, the good news is South Africa is sitting over here, which is above the emerging market average. The bad news is that we are not the highest out there. If you look at some other countries that are sitting with higher interest rates, which means they probably will attract more capital than South Africa. And I've done that in nominal as well as real terms. It's more prominent in nominal terms than it is in real. But we're not exceptionally high. So let me wrap it up by just balancing out the inflation risks. I think global rates are going higher. Oil prices and electricity prices are elevated, especially when you take into account the rand. So in rand terms, they are elevated. Inflation expectations, whether we look at the survey, the market, they're all above the target band. And the final hawkish thing to consider is the MPC decision, that all members voted for a 50 basis point hike. Tells us that they're in quite a hawkish mood. Having said all that, there are some dovish considerations. So global demand is weak, domestic demand is weak, inflation is falling, core inflation is expected to peak soon, and policy rates are restrictive. We run in positive real policy rates, and our neutral rate is around 7%. We at 8.25. So we are running restrictive policy, and our relative policy rates are above the average. But like I said, we're not the highest, but we are above the average. I would say that's on balance a bit more of a dovish factor. But as you can see here, it's a very tough balancing act that the Reserve Bank is walking, because it's kind of evenly keeled. I would say, though, that some of these hawkish factors are a little bit, probably deserve a bit of a higher weighting. And in fact, that's what the market is telling us. If you look at the market, the so-called forward rate agreement curve, which tells us what the market is pricing in terms of rate hikes, we're currently sitting at 8.25. The market thinks that, looking at those balance of risks, the Reserve Bank could actually hike rates even further, basically up to 9%, a little bit above 9%, and then things will level off. And these expectations have adjusted higher even after the last MPC meeting. So the market is scared that inflation is still high and the central banks will still need to hike rates. But it really isn't a fait accompli. We have hiked rates already quite a lot, and as I say, there has been a number of factors that are quite dovish, as I showed you in this previous task. So as always, it's going to be very interesting to see what the Reserve Bank does, but hopefully that gives you a sense of how the central bank thinks about it. And what the potential outlook is for policy rates. David, let me stop there. I've overdone it again. But, thank you very much. I'll take questions after.
Yeah, no, that was great. I've got a few questions here for you. And I know that we've now just reached the 11 o'clock hour mark. But let's see if those of you are keen to stay on for another 10 minutes, so we can try to get through some of these questions. Because I think we've got a couple of interesting questions here. So from Mike, and effectively also related for Nizwe, there's questions around the CPI basket. So firstly, the first question, which one of the questions Mike asked in the chat on the side was, why is it that CPI is staying flat when PPI has come down so fast? And I think you answered that after you'd asked the question in what you were talking about how it's it's ordinarily a leading indicator. But on top of that, there was a question around, so that usually does precede inflation, CPI itself coming down. At least that is a positive kind of sign, as you say, for dampening inflation for the future. But one of the questions was around the inflation basket. So Craig was saying, can we not just change the inflation basket to make inflation look better, then we're good to go? I know, for instance, in the States, if I'm correct, they change the inflation basket yearly, which shocked me when I heard that the other day. With us, for interest sake, with our inflation basket, how often do we change the inflation basket? Every 5 years?
Every 5 years, yeah. Every 5 years. And I think changing it every year, I think you start shifting the goalposts
system
around too much. Yeah.
Yeah, correct. So in the end, it is better, I guess, from a policy point of view, to rather have a set goalpost. So that's always something that's actually shocked me that gets changed yearly.
Yeah.
But effectively, if we're going to be gaming the system, because as we all know, if CPI inflation is feeling higher than CPI is even being measured. So that's good to know. There was another question: Does the SARB consider other interest rate cycles globally when consider interest rate hikes, specifically US Fed? I think you answered that. So it is effectively implicit in our pricing and part of the decision-making process. So that you answered already. As consumer, do we want interest rates to be higher or inflation? as a consumer, do we want interest rates to be higher or inflation to be higher? From Stefan.
Yeah, it's a bit of a chicken and egg, but I think ultimately, if the consumer, at the moment is feeling the pinch because interest rates are moving up, quite extensively. But that is to ultimately help bring inflation down further along the road. So maybe it will take 18 months, 12 months, whatever the case is. But it's you have to sort of stop inflation, because if you don't stop inflation, you can keep interest rates low, but inflation will be so high that your money will go nowhere. So you won't be able to afford things, either. So, the argument is rather let's hike rates now and bring inflation lower. And the key thing is, really, everyone's got to buy into it, because it's no good, you and I, we're all taking salary, inflation-related salary increases, and then sort of other sectors of the economy are jacking up, their prices by 10, 15%.
Yeah.
That can't work. Everyone's got to buy into it, because then that brings down inflation, and it forces you to find ways to be more productive. And that ultimately has to be better for the economy. So unfortunately, it's a myth to believe that, higher inflation is only a rich man's story or problem. It's not. It's very much a poor man. A poor man cannot afford to fight inflation. If the cost of living goes up, he is dead and buried, so you need to keep inflation lower, but it does unfortunately require periods of aggressive rate hikes from time to time.
Yeah, and that feeds into a question we got from Senza Kile on the side there, where it was asked, how do the different sectors of the South African economy respond to change interest rates? I think you covered that a little bit if you looked at, for instance, the car sales demand in the previous slide. And how that is kind of how the demand there has come back in line.
So everyone will respond. It's a very good question as well. It's always people will respond differently, and the capitalist environment that we live in means that people will get away with the increases that they feel that they can. So the more competitive a sector is, the more unlikely people will just jack up their prices, because they're scared their competitor is going to come through and undercut them. But in a market where you've got a monopoly, so again, I'm sorry, I'm picking on Eskom, but they've got a monopoly on prices. We can't really go elsewhere. And that allows them to increase prices as much as they can. So, it all depends from sector to sector. Some sectors will feel that they can pass on higher costs, and they will. But competition can help eliminate that. So we need competition. Competition goes hand in hand with inflation targeting.
Yeah, and I think that's an element which at this stage in the cycle, the SARB, if you looked at your list of, the list of positives and negatives for inflation and interest rates going forward, on the negative side, we are sitting with a lot of inflation which is passed on, which is not linked to necessarily, isn't as controllable from interest rates increases and decreases to manage. So that is something which is going to be a bit of a balancing act for the SARB. I think that's a good place to end. I think another thing which I was very encouraged by from your slides, if you look at the 20-year, 10-year, and 5-year inflation averages, we always get lost in the noise of inflation, and we actually don't see what a good job the SARB has done over the last 20 years. From Mboweni to Marcus to now Letsecha Kganyago, and how that has been well managed, relative to the hand they've been dealt as governors, from a policy perspective within South Africa. So that's encouraging.
Absolutely.
So I think that's a good place for us to end, Mike. I just want to say thank you so very much for your valuable time this afternoon. I am wary of the time, and just for everyone who's on the call today, I just want to let you all know, please keep an eye out for our next thought leadership webinar. We're actually going to be having Paul Nixon from Momentum Investments, who's head of behavioral finance, at Momentum, coming to give us a chat around the psychology of money. But I'm sure you'll all see invites that'll go out in the next few weeks to invite for that. So please join us for that if and when you have a chance. From our side from Milpark School of Financial Services, I want to say thanks to Mike again, and thanks to all of you for joining us this afternoon. And we hope you guys have a good rest of your week. Thanks again, Mike.
Thanks so much for having me, everybody. Thanks. Go well. Bye-bye.